It's now my pleasure to welcome everyone to today's conversation. My name is Sara Faurer. I'm a wealth advisor at Ellevest, and I am thrilled to be joined by Chief Investment Officer Ankur Patel. Hey, Ankur.
Hey Sarah, good to see you.
How are you?
I'm good. I'm good. Just enjoying the summer, enjoying the World Cup. I don't know if you've been following, but
It's been so fun. I
yeah.
am the biggest bandwagon soccer football fan as of a few weeks ago.
Yeah. I think me, you, and everyone else in
Yeah,
this country,
yeah,
right?
yeah.
It's hard not to when it's in your backyard, right?
Have you been able to catch any of the games live or just watch on
Yeah, I was able to catch one game live. I took my son, and it was such a great experience. I'll tell you, like the energy and the vibe was just from everyone all over the world, like just meeting new people from everywhere. It was super cool, super cool.
Yeah. I am taking in every bit of content I can to see different fan bases, different countries interact with each other online. It's been such a blast to see that.
Yeah, they're
So,
loving being here, which
yeah,
is great to see. Great to see.
it's heartwarming for sure.
Yeah.
But yeah, we're midway through the year. It's hard to believe how quickly time is passing, and there's no shortage of things to talk about when it comes to markets and headlines. So, should we dive in?
Let's do it.
All right, let's start with the stock market. Been a lot of discussion lately, but really since the beginning of the year, I would say, about whether we're in an AI bubble, especially after the volatility we've seen really across the big technology stocks this year. So, from your perspective, what distinguishes healthy enthusiasm and real growth that's driven, by investments in this transformative technology from the kind of speculative bubble that investors should have real concerns about?
Yeah, and that concern's growing. It's hard not to hear people talk about a bubble when we're dealing with AI. I feel like it's an ongoing story at this point, even though AI is not so new, but it's still in its early innings, but it's still something we've been talking about now for the last 2 years. And so, yeah, let's get into this. Let's go through some data points that I think can help guide the conversation and show everyone sort of what people are concerned about right now, but also why they might not need to be as concerned that this is a bubble. And so right now, one of the first things is just look at where the market is, right? So whenever market prices continue to go higher year after year, even into this year, this just picture looks concerning. It's a picture of, hey, have we run too far? Has the market gone past its keys? The market being more concentrated is another, I'd say, concern that investors have with the fact that if this is a bubble or not, the top 10 tech names are close to 40% of the S&P 500 right now. And so that's even more concentrated than the big names used to be in the past. So that's sort of that kind of rings some alarm bells for people, especially if there's going to be an issue within, something like AI and things slow down. It could take a lot of companies with it. I think when you look at the CapEx numbers and all the spend that the hyperscalers have, that brings a lot of concern. I think this year it's up to 700 billion, which is a massive, massive amount,
Yeah.
something we've never seen before. And the big question there is obviously, is there going to be a return on investment, right? Are we just spending all this money and there's no end in sight, and there might not be a great return for this amount of investment? That's a big concern, and it kind of conjures up the bubbles of the past where you had a lot of infrastructure build out. If you look at things like when railroads came out and all the extra railroads that were built that weren't utilized and the money that was lost there, you look at even in the tech bubble of the 2000s, all
Mhm.
that fiber that was laid, right? The hope and promise of, the internet at that point. It was just very early. And so this being an infrastructure play right now in terms of AI and all that CapEx, those are sort of the things that people are concerned about. I think for me, when I look at this and try to suss out, is this a bubble? What are other things that we should be looking at? One is primarily earnings. The one of the most interesting things that we've seen this year has been we came into this year at very high, elevated valuations. The stock market, the S&P was trading at about 22 times earnings, forward earnings. So that's $22 for a dollar of next year's earnings. Uh, the market has gone up since then. The market's gone up close to 10%, and valuations have actually come down. So that's not typically something that you normally see. You don't normally see stock markets go higher, but earnings actually accelerate faster than the stock market. It's usually the other way around. So that's been a very interesting dynamic, not something that you typically see in a bubble-like scenario. You can see here the earnings shaded in this light green here, just accelerating, sort of continuing to accelerate at a pace that not many saw when we were coming into this year. It was meant to be healthy growth, but not at this pace. I think some of the other things that, are good call outs are just the fact that that CapEx figure that everyone's concerned about from the hyperscalers, the Mag 7, and those are still being driven by earnings. So that investment, that spending is not coming from sort of a debt-fueled expansion right now. It's primarily coming through earnings still. And while that kind of hurts their cash flow in the short term, it still is a lot more healthy of a scenario than other bubbles in the past where we've seen companies take on a lot of debt to just fuel that type of expansion. And so, one of the other parts of this is also all those companies that are involved in that spending, this Mag 7 cohort or the top 10, you can look at the performance of these names. The market is actually discerning a lot of winners and losers at this point. Sort of that trade that went on for so long, you can kind of see last year, it sort of the first half of the year was like almost a straight line up for a period of time. Goldman had a good stat recently. They published that the correlation between those names was close to 80%. And
Mhm.
towards the back half of the year, that changed to down to 20%. And so, usually in a bubble scenario, all names linked to a theme will move in one direction together. And right now, it seems like the market is paying attention to which companies might do better, which ones might do worse off. And that's not usually something that you see in a bubble either. So I'll stop there. I think those are, the main things that I think we look at when trying to figure out, hey, are we in a bubble or not?
Well, we can't talk about AI enthusiasm in this frenzy without SpaceX. So, how does the SpaceX IPO play into some of this bubble talk from your perspective?
Yeah, it definitely didn't help. I'll say
Yep.
that at the least. Obviously, a huge story last month, and one that, was quintessential to the bubble talk, I'd say, because of the valuation and the fundamentals were not in line, right? You have this company that's IPOing over 1.7 trillion that has no earnings at all and is spending lots of money. That does feel very bubble-like on its
Yep.
own. We've seen the stock um, IPO close to 150, 160 and go all the way up to $220 and only to round trip and more recently come back down to earth and back down below those IPO levels. And so I think there to me it's a sign that one is the IPO market is opening where we're seeing more activity, which is a good sign, which is healthy for the markets. And two, I think the fact that the markets are not just pumping the price higher, as you might expect in a bubble-like scenario, they are, sort of discerning and taking a long look at sort of those valuations and treating it fairly, it seems like. That's a good sign to me. It's sort of the market saying, okay, we will take some of these IPOs, but um, the public markets are discerning the winners from the losers right now, and that to me is not bubble-like
Yep.
behavior. I think we even saw some of the companies that came out around that time announcing their IPOs, like OpenAI,
Mhm.
was hoping to IPO this year, and now after seeing this market action, I think has retreated a bit and said they're planning for 2027 now.
Mhm.
So a lot is changing very quickly, but I think it's a healthy sign for the markets that the pricing isn't getting out of control.
Yeah. And along the lines of some of that discerning behavior in the markets, I think what's been interesting to watch is sure, the Mag 7 and these big tech stocks continue to dominate headlines, but other parts of the market, like the US small cap or even outside of the US, emerging markets, value stocks really across the board, they've sort of quietly outperformed. What do you think the key factors that are driving that outperformance are? And what does this broadening market leadership tell us from a long-term investment perspective?
Yeah, I think there's a couple of reasons for that. All those buckets and asset classes have different drivers for their returns, and I think we can differentiate, but let's take a high level look at sort of where we sit today. And what you're calling out here is essentially the stock market in the US is up 10%, but if you look outside the US and emerging markets, we're up 21%. If you're
Yeah.
looking at smaller companies in the US, up 20%. Um, and why is that? What are some of the reasons that might be causing this? And I think one, when you look at the balance of valuations to fundamentals. So if we look here and say, well, where are these buckets trading today? Well, if you look at smaller companies versus larger companies, they're cheaper right now, um, by by a good amount. And then you can look at earnings growth and say, well, earnings growth is expected to be almost the same, if not slightly worse for small caps. But this is where we've seen, places like emerging markets have stellar earnings growth more recently and still trade at very, very cheap valuations. So
Mhm.
this sort of dynamic here has been a good setup. I think you've had improvements on um, the price of oil and commodities, which has been a headwind in the past. But the emerging markets as a cohort are benefiting now that oil is coming down. So you have a handful of reasons for this group to be doing well. I think within the US and looking at smaller companies, you've had a period of time where interest rates went from 0 to 5%. Almost every company had to reassess their balance sheets, their expenses, and sort of tighten up their leverage. And on the other end of that now, after a couple of years, are in a much better place so that now when revenues are coming in, they're able to take advantage of that operating leverage and just have better earnings to show for it. And so that sort of earnings picture is getting better because those companies are in better shape right now. And I think as we see the hyperscaler spend across the economy, it's gonna infiltrate lots of different cohorts, and that money has to go somewhere. So it's not that they're spending into the abyss and that money doesn't go anywhere. There are companies that are not just the NVIDIAs that are in the receiving end of that CapEx, and that is going to help the economy at large.
We look away from stocks more at the global market, headlines this morning, yesterday with, NATO conference, just in general, we've, experienced another reminder that geopolitical events, from everything that's going on in the Middle East to ongoing trade negotiations to policy uncertainty, can create some short-term market volatility. But at the same time, we've seen price of gold fall to $4,000, down from 5,500 earlier in the year. We've seen Bitcoin down significantly, back down to 60,000. Why haven't these held up well during this period of geopolitical uncertainty? How do we think about those moves?
Yeah, this has been interesting to watch too. I think if you had called a war this year and said this is going to happen, you'd expect both of these assets to do really well in that scenario. I think if we look at each individually, it becomes a little bit more clearer. And I think the story with gold really has been, I think, twofold. One is this is should be a hedge during geopolitical times, and it sort of was, I'd say, in terms of having this rise sort of up to the point where the war started and a little beyond that, and then seeing the sort of decline was, I think, attached to the hopes that the war would end sooner rather than later. So it did play sort of some role in terms of providing that hedge, but I think because the story with the war has been that this should be something that was concluded sooner rather than later, and that was the messaging around it, you did see this decline off the backs of that. I think there is a component of currency here too with the dollar and what we've seen there in terms of the dollar weakening and or the dollar strengthening rather, because what we've seen is a period where the expectation for interest rates went from, hey, this year we were coming into this year, we might expect a rate cut to, oh no, there could be more inflation. We might get an increase in interest rates. And typically when you have an increase in interest rates, there's a rise in the value of the dollar, and that typically doesn't bode well for, I'd say, the international central banks that are buying all this gold right now. And so you see a slowdown there, and that's also attributed to sort of the decline in price of gold. I think with Bitcoin, if we take a look, what we've seen is this really hasn't played out like digital gold, as a lot of folks have said. And to me, when you look at this chart, it moves a little bit more like a risk asset, maybe even a leveraged risk asset. And unfortunately, what we've seen is all of the promise and hope around institutionalizing Bitcoin, making it accessible via the ETFs has actually reversed course a bit. We've seen a lot of outflows over the last quarter, and that's driving more selling pressure. Whereas initially the story was, hey, this is going to be approved by the SEC and ETFs are going to own it. There was more institutional ownership attached to that. It's sort of reversing course now, and we're seeing a lot of net negative outflows, which we haven't seen in a while. So that's pushing the price even further below. But I'd say in terms of it providing a hedge, it really hasn't, unfortunately.
Yeah. You touched on interest rates. We have a new Fed chair in Kevin Warsh, who signaled a real change in how the Fed may operate going forward. He's taken over at a moment when the debate, we've really shifted from how many cuts will we see before the end of this year to will they actually hike or raise rates? What have, his first few weeks told us so far, and how much should investors feel, um, about the Fed's independence now that he's begun?
Yeah, maybe we start with the independence question. That was the big one, I think, coming in for him. It was, is he going to come in and try to lower interest rates immediately? What is the risk of that? Initially, we've been talking about this for months now. This is still a committee. He is still one there of 12 voting members, and he wouldn't naturally have the ability to do that, even if he wanted to. But even on top of that, I think listening to him in his first press conference, it was pretty clear that he was leaning towards his roots as more of a hawkish member and very focused on inflation. That, he made that very clear that that was his goal, and the markets also are pricing that in now too. And so the markets reacted immediately, pushing for a potential rate hike towards the back half of this year. That's what this chart is showing us. Whereas if we looked at this coming into this year, it was showing a rate cut. And
Yep.
that's purely driven by, I think, one, the inflation picture that we're in today, seeing the last inflation print come in higher off the backs of higher oil. We'll see how that changes across the summer. There's still going to be some time before we have more Fed meetings in September and October. So if the more recent um, price of oil is any indication, if that inflation number comes down, maybe that changes this picture a little bit. But I think in terms of, one, independence, it seems pretty clear that the market's adjusted to his frame of, they are going to be very focused on inflation, and we
Mhm.
might actually get a rate increase towards the end of the year. So I think that's a good checkbox for independence. I think, the other nuances tied to him are interesting and might have some ramifications for markets. I think the main one being the fact that he is removing all forward guidance, which the markets have been very attuned to in the past, right? Everyone sort of clinging to every word that's said about forward guidance and what that implies for markets. And I think it shifts sort of some of that volatility that we may have seen before, during, and after Fed meetings to more during data releases around employment and inflation. And so we could see that going forward, but that is an interesting change that I think he's brought about. And I'm curious to see what other changes he might have in store as well.
Yeah, time will tell on that front. So When markets feel uncertain like this, it can be tempting to want to do something. What's your advice for long-term investors today who might be feeling some of that? Are there any portfolio changes that we're thinking about making? And if not, why not? What's driving that?
Yeah, that's a great question. It's something that we're constantly looking at. I think this environment should hopefully push everyone into looking at their allocations and making sure they're diversified. Um, no one would have called an emerging market rally this year on the backs of a rally that no one predicted last year, right? So you have two consecutive years where you're seeing international emerging markets outperform. If you don't have those in your allocations, you're most likely underperforming to a certain degree, especially if you have a lot of that tech exposure. So the number one thing for me is making sure you're diversified. One thing that we have been doing has been focusing on rebalancing this year. And when you have markets that run like this, you always want to be mindful of your risk limits and taking gains when they're available. And so that's helped us when we've seen these strong runs in corners of the market that we may not have anticipated. We're able to reduce that exposure, rebalance it, put it into areas that might not be doing well, because those could be next year's winners, right? And so for us, that's been more of the focus lately. It's where do we see opportunities to rebalance and just build a better diversified portfolio that can take advantage of those changes over time.
Yeah.
What would you say, Sarah? What are you talking to clients about right now? What type of advice are you giving and actions are you taking?
I think when we think about wanting to do something, we're probably forgetting then or discounting that doing nothing, it's actually a powerful and intentional action, right? It's a choice to not react to what's happening in the short term or to maintain allocations or to stay invested, to look through some of that short-term volatility. That's an active choice that we're making as investors or as, that our clients are making. And I think it's Warren Buffett that talks about, investing, it doesn't necessarily require constant action. It rewards disciplined inaction. And I love that thought, right? If you do have the right allocation for your risk profile, if you do have that diversification, if you do have that long-term investor lens, then the real crux of what we're talking about is disciplined inaction when times feel as uncertain or as questionable as they do right now. So I think it's not easy to do that, but it is an action in and of itself to remain disciplined to the plan and not make reactionary moves.
I love that.
I think that is all we have for today. There's no questions from the audience unless anyone has them right now. Feel free to put them in the chat. But as always, your Ellevest advisors or point people are always here to answer any questions that come up, and we'll be here next month to talk about what else happens in the market from now until then.
Thanks, Sarah. Thanks everyone for joining. Appreciate it.
Bye.
Bye.